What I want to talk about today is the differences between a stock sale or an asset sale in selling a company. First of all, I'm not a tax professional. The purpose of this discussion is to give a business owner basic topographical information about tax issues such that they can talk to their CPA, who is the only person that is really qualified to be able to give tax matters. This is just an overview of the tax implications of a sale. Basically, the differences between selling stock and assets are, in selling stock, the business owner is selling the corporation shares of stock. Everything is going with a stock sale. In an asset sale, the buyer is actually setting up his or her own corporation and just buying the business assets. There are no shares of stock being sold. The difference is pretty easy to understand. Stock is stock and assets are assets. But the big difference is the tax implications and the acceptance of liabilities involved between the parties. One, when a C Corp owner sells stock, the C Corp owner is largely going to be taxed on the basis of capital gains, whatever the capital gains rate is at the time of the year in the sale. And that rate amount is changing yearly at this point. When a C Corp owner, however, sells assets, then that C Corp owner can be involved in the double taxation situation. That is, first selling on the corporate tax rate, then whatever falls out is left selling on the income tax, personal income tax rate. Sellers that are C Corp owners need to be very aware of the tax implications between an asset sale and a stock sale before they get started. The only person that really is qualified to give that advice is their CPA. Buyers' implication on buying stock also is significant. One, buyers step into these, when they're buying stock, step into the seller's shoes as far as their balance sheet is concerned. Their depreciation, what's left of depreciation of their assets. If the seller has depreciated fully all of the assets that the buyer is purchasing, then there's no depreciation expense left for the buyer to throw off as a tax expense. However, if the buyer is buying on an asset basis, then the buyer is able to establish the market value for their assets and start their depreciation expense from there. So that, in certain cases, when there are a lot of assets being sold and the market value of those assets is significant, a buyer buying stock may really be burdened by not being able to offset their income with a depreciation expense. One other implication of a buyer buying stock is that that buyer steps into the shoes of the seller from the date of seller's incorporation. Any undisclosed liabilities can be environmental, and the business owner does not have to own the company. You get to be an operator, can still have environmental issues. There could be hidden product liability issues that haven't surfaced at the time of sale. There could be service-related issues, employee issues. The point being, the buyer in buying stock steps into the seller's shoes from the date of incorporation on any undisclosed liabilities. The only person or persons that are capable of giving legal advice on this issue would certainly be an attorney, and the buyer or the seller that should consult his or her attorney to get advice. This is just a topographical sketch. There are many other tax implications in selling a company, depending on the components involved. Business owners are well advised to not only talk to their CPA before the sale, before they start the process, to understand fully the tax implications of sale, but also their attorney to understand the legal implications of the sale for both on the seller side and the buyer side. Again, the only people that are qualified to give tax and legal advice are the CPA and the attorney. This is just a layman's approach to discussing this subject. My name is Bill Whitehurst, Whitehurst Mergers and Acquisitions in Dallas, Texas.